One of the most significant aspects of the deal between ONEOK and Magellan is the price that ONEOK will pay for each Magellan common unit. According to the joint statement, ONEOK will pay $25.0.6670 shares of ONEOK common stock for each outstanding Magellan common unit. This represents a premium of 22% based on Magellan shares' closing price on May 12. This means that ONEOK values Magellan highly and is willing to pay a generous amount to acquire its assets and operations. The cash and stock combination also allows Magellan unit holders to participate in the future growth and cash flows of the combined company. The deal will create a diversified North American midstream infrastructure company with predominantly fee-based earnings, a strong balance sheet and significant financial flexibility. The deal between ONEOK and Magellan Midstream Partners is not only a huge transaction in the midstream oil and gas industry, but also a strategic move that will transform ONEOK's business profile and growth prospects. By acquiring Magellan, ONEOK will diversify its portfolio of assets and expand its presence in the refined products and crude oil transportation markets. This will make ONEOK more resilient to commodity cycles and enhance its ability to generate stable cash flows from fee-based contracts. Magellan is one of the largest independent pipeline operators in the U.S. With a network of over 10,000 miles of pipelines that transport gasoline, diesel, jet fuel and other refined products from refineries to terminals and end users. Magellan also owns and operates over 2,000 miles of crude oil pipelines and storage facilities that connect major production areas to refineries and export terminals. Magellan's assets are strategically located in key demand centers and supply hubs, such as Texas, Oklahoma, Colorado, New Mexico and the U.S. Gulf Coast. By combining with Magellan, ONEOK will gain access to these high-quality assets and increase its exposure to the refined products and crude oil markets, which account for 21% and 35% of Magellan's earnings before interest, taxes, depreciation and amortization, EBITDA, respectively. ONEOK will also benefit from Magellan's long-term contracts with customers that provide predictable revenue streams and minimal volume risk. According to ONEOK's presentation, the combined company will have 44% of its business in natural gas liquids, NGLs, 21% in refined products, 19% in natural gas gathering and processing, 14% in natural gas pipelines and 2% in crude oil gathering. The deal will also create significant synergies and growth opportunities for ONEOK. The company expects to achieve annual cost savings of $100 million by 2025 and $150 million by 2027 from operational efficiencies, reduced corporate expenses and lower capital spending. The deal will also enhance ONEOK's financial flexibility and credit profile, as it plans to use cash flow from Magellan's assets to reduce debt and fund future capital projects. Moreover, the deal will open up new avenues for organic growth and expansion in the refined products and crude oil markets, as ONEOK will be able to leverage its existing relationships with customers and producers to offer integrated solutions across the midstream value chain. In summary, the deal between ONEOK and Magellan Midstream Partners is a game-changer for both companies and the midstream oil and gas industry. It will bring natural gas-focused ONEOK into transporting refined products and crude oil, which will make it more resilient to commodity cycles and enhance its growth opportunities.